welcome to our Advanced Trading Concepts series. In this segment, we explore the concept of risk parity and the use of alternative risk measures in portfolio management. These approaches represent a shift from traditional investment strategies, focusing on balancing risk to achieve optimal portfolio performance. Risk parity is a strategy that allocates capital based on risk, rather than market capitalization or expected returns. It aims to create a more stable and diversified portfolio by ensuring that each asset contributes equally to the portfolio's overall risk. In a risk parity portfolio, assets with higher risk, like equities, are given a lower allocation, while lower risk assets, such as bonds, receive a higher allocation. The goal is to balance the risk contributions of all assets, reducing the portfolio's vulnerability to market volatility. For example, in a volatile market, a risk parity approach might reduce equity exposure while increasing allocations to bonds and commodities, aiming to maintain an even distribution of risk. Alternative risk measures, such as value at risk, VAR, conditional value at risk, CVAR, and drawdown measures, provide different perspectives on risk compared to traditional metrics like standard deviation. VAR estimates the maximum potential loss over a given time frame, while CVAR assesses the expected losses beyond the VAR. Drawdown measures focus on the decline from a portfolio's peak to its trough. For instance, a portfolio manager might use VAR to determine the potential loss in a portfolio during periods of market stress, helping to inform risk management decisions. Implementing risk parity and alternative risk measures requires sophisticated analytical tools and a deep understanding of market dynamics. These strategies often involve leveraging to equalize risk contributions across asset classes, which can introduce additional complexities and considerations. An example is a hedge fund that uses leverage to increase exposure to bonds within a risk parity framework, balancing the higher inherent risk of its equity investments. One of the challenges in applying these strategies is ensuring the accuracy of data and the appropriateness of the models used. Market conditions can change rapidly, and the assumptions underlying risk models may need constant reevaluation. Looking to the future, the field of risk-based portfolio management is likely to evolve with technological advancements. Artificial intelligence and machine learning are set to play a larger role in identifying and managing portfolio risks in real time. In conclusion, risk parity and alternative risk measures offer innovative approaches to portfolio management, focusing on balancing risk for more stable and potentially more rewarding outcomes. As financial markets continue to evolve, these strategies will become increasingly important tools for portfolio managers and investors alike. Exciting topics await in our Advanced Trading Concepts series. Join us as we deepen your insights into the financial markets. Thank you for watching. Don't forget to subscribe to our channel and hit the bell icon so you never miss an update.